Hi everyone, welcome back to the channel. Is it now the right time to buy a home or should you keep renting? In 2026, with higher interest rates, stubborn inflation, and an uncertain economy, this is one of the biggest financial decisions many families will face. Today we are diving deep into the housing market outlook for 2026, the job market, interest rates, government policy, and historical cycles that drive real estate, including the famous 18-year property cycle. We'll talk about affordability, economic trends, and I'll walk you through how to decide whether renting or buying makes sense for you in the next year. So grab a coffee, hit that like button, and let's break it down. Let's start with the big picture. What's the housing market likely to look like in 2026? According to Fannie Mae, mortgage rates are expected to move below 6% by the year end of 2026, roughly 5.9% for a 30-year fixed loan. Most experts expect home prices to rise modestly, around 3 to 4% nationally. That's a slowdown from the crazy double-digit growth we saw in earlier years, but still positive overall. Some forecasters like Zillow expect a small increase, around 0.5%, while others think prices could even dip slightly or in few overheated areas. The key point is this: 2026 is shaping up to be a stabilization year, not a crash, not a boom. Inventory is slowly building, and buyers have more negotiating power than they did during the pandemic frenzy. But real estate is always local. Some cities, especially in the Sun Belt and Midwest, may see steady growth, while overpriced coastal markets could cool or stay flat. Next, let's talk about jobs and the overall broader economy, because housing follows employment. The US job market remains surprisingly strong, but the momentum is slowing. Unemployment is still low, but wage growth has cooled, and some sectors, especially real estate, construction, and tech, are tightening up. Economists expect a gradual slowdown, not a full-blown recession. Inflation remains sticky, which means the Federal Reserve might not cut rates as quickly as people hope. But by late 2025 and into 2026, most forecasts expect several Fed rate cuts, potentially lowering mortgage costs and improving affordability a bit. The takeaway: the job market in 2026 should still be solid enough to support housing demand, but not strong enough to push home prices sky high again. Think of it as a balanced, cautious market. Now let's zoom out. Did you know housing markets often move in long, predictable cycles? There's a well-known theory called the 18-year property cycle. It suggests that real estate tends to go through roughly 18 years of boom to bust, to recovery, and back to boom again. According to this cycle, we are now in the late expansion or maturity phase, where prices cool but don't necessarily crash right away. If this pattern holds, we may not see the next major correction until later in the decade. Of course, cycles aren't perfect. They are influenced by government policy, credit markets, and demographics. But historically, housing peaks often happen near the end of the economic expansion. When interest rates rise, credit tightens, and affordability becomes stretched. Sound familiar? That's exactly where we are right now. So, the 18-year cycle gives us context. 2026 might be a plateau before the next big shift. Interest rates are the heartbeat of the housing market. In the 1980s, mortgage rates were over 16%. In the 2010s, they averaged under 4%. That's an incredible historical range. In 2025, rates peaked above 7%, and that froze the market. Now, as inflation cools, most experts expect rates to slowly drift down into the mid-fives by the end of 2026. The Federal Reserve's action will be key. If inflation stays under control, we could see several rate cuts, making homes a bit more affordable. But if inflation sticks around, the Fed might hold firm, keeping rates higher for longer. Policy also matters. Changes in zoning laws, property taxes, and first-time buyer programs can affect local supply and demand. Some states are introducing incentives to build more homes, which could ease inventory shortages over time. Bottom line, 2026 could be a friendlier year for buyers, but only if inflation cooperates and policymakers stay balanced. Now let's talk about affordability, or really the lack of it. In many cities, the cost of buying a home is higher than it's been in decades relative to income. The typical American household today needs over 30% of their income just to afford the median mortgage payment, far above the historical average of 20%. Even though home prices have cooled slightly, high interest rates have kept monthly mortgages elevated. Historically, homes were much more affordable, especially in the 1990s and early 2000s. But over time, wages haven't kept up with property prices, and supply has lagged behind demand. For many families, that means we are stuck, too expensive to buy, but rents keep going up. So when we talk about rent versus buy, we are not just comparing numbers, we are comparing flexibility, mobility, and long-term financial health. Let's break it down with a practical framework. There are 6 key variables you should consider before deciding whether to rent or buy in 2026. Number 1, your time horizon. If you plan to stay in the same home for less than 5 years, renting usually wins. If you plan to stay 10 years or longer, owning usually comes out ahead. Number 2, monthly costs. Compare your rent, utilities, and maintenance costs to what a mortgage, taxes, insurance, and upkeep cost would be each month. Number 3, down payment and opportunity costs. That's the money you could invest elsewhere instead of locking it in the house. Number 4, appreciation expectations. If you believe your local market will rise 3% per year, ownership becomes more attractive. But if prices are flat or falling, renting offers safety and flexibility. Number 5, tax benefits and credits. Some homeowners get mortgage interest deductions or state incentives, which can change the equation. And number 6, personal stability. If your job is secure and you want roots, buying can make more sense. If you expect career moves or life changes, renting gives you freedom. Let's do a quick example. Say you rent for $2,000 a month in Sunbelt City and your rent increases 3% a year. Or you buy a $350,000 home with 20% down at a 5.9% mortgage rate. Over 10 years, if your home grows 3% annually, owning may build more wealth, but only if you stay long enough to offset the upfront costs, like closing fees, property taxes, and maintenance. In contrast, if you plan to move within 5 years or if prices stagnate, renting could be the smarter play. Remember, home ownership is not just a financial decision, it's also emotional, lifestyle, and deeply personal. So here's the bottom line for 2026. The housing market is stabilizing, rates are slowly improving, the job market is steady but cooling, affordability is still a challenge but not impossible. If you can afford a home you love, plan to stay for long term, and are financially stable, buying in 2026 can make sense. But if you value flexibility, expect to move, or believe prices could dip further, renting remains a wise and stress-free option. Don't get caught up in the hype. Run your own numbers for your city and your situation. Thanks for watching. If you find this helpful, hit that like button, subscribe, and share your thoughts in the comments. Tell me your city and I'll run a custom rent versus buy example in a future video. Until next time, stay smart, stay informed, and invest wisely.